but it's something that we're paying attention to what's happening in this cycle, looking at the patterns, looking at history, looking at where the world's going. And I think that's the environment we're moving towards, where you're going to want to have real assets, hard assets over financial assets here. This is the Realize Your Wealth podcast by Aretec Wealth. We want you to be wealthy. We want you to feel wealthy. We want you to realize your wealth. All right, here we go. We're back. It's Friday. We've got matching shirts on. I just realized, which is good. But no, good, decent week in the markets. Gonna update on that. Things are humming along for the most part. The U.S. markets closed today, but humming along. But how you doing, Greg? Big World Cup win last night. How are you feeling about that?
Yeah, I'm feeling good. It's not just the markets that are humming along. Team Canada is humming along with a huge win yesterday. I think they actually broke some records in terms of host nations and goal differential. And, we also got a hat trick yesterday. So it was just a good, fun game to watch. Really good for Canada. We're in pole position to advance out of the group. So even if you're not a soccer fan, it's pretty fun. The whole country's excited. So I'm definitely excited, so it's a lot of fun.
Yeah, I thought they could have and maybe should have put you in there. I think you could have scored a goal yesterday.
Yeah, exactly. Goals were plentiful yesterday. I don't know how I would have fared. I don't think too well, but the boys were having fun out there yesterday. That's for sure.
Hey, that's good. No, it's fun. It's fun, very fun experience. Host country. We've got it in. It's going on in Toronto, which is awesome. All across Canada, which is awesome. But yeah, looking forward to getting into things here. Sort of an interesting week where generally things directionally have been up, but we got a little bit of a speed bump because we had the Fed meeting on Wednesday, which sort of put some dampers on the market. But what's going on? Give us a little bit of an update on things, Greg.
Yeah, so the market started off the week pretty strong. Some good news with everything going on in the Middle East, Iran, US, like that seems to have calmed down a little bit. But then to your point, well, the markets were getting a little jittery throughout the week. The new Fed chair, Kevin Warsh, came in, and I don't think anyone was expecting him to do anything differently, but I guess the tone was maybe a little bit hawkish, and they more just reconfirmed that their mission and their mandate is to get inflation back to that 2% target. So I think the markets interpreted that maybe a little bit more hawkish than anticipated, and they kind of sold off and were a little bit choppy overall. And I think that kind of ties into just the overall positioning, what we want to talk about today.
Yeah, I mean, I was at a dinner this week. So I was at the PMAC dinner, which is the Portfolio Management Association of Canada. So it's a lot of people like us, portfolio managers, money managers, chief investment officers, institutional investors in Canada. And that's what there was a very good speaker that was sounded like a little bit like our podcast when I was hearing the theme. So it was a gentleman, Lawrence McDonald, and I won't get into the whole bio and background, but could look him up. But was talking a lot about just state of the world right now, what's going on in markets, positioning on portfolios, and a lot of the themes seem to line up where we've been going for at least the last couple years at Aretec. And I was listening pretty keenly because a lot of the ideas align. So I figured we could talk a little bit about that, just thematically, positioning wise, where we're going, where we see these markets directionally headed here.
Yeah, and I think a lot of that positioning has to do, to your point, kind of the state of the world right now. Inflation is running hot most everywhere. We've actually seen, I believe this week or within the last couple of weeks, the Bank of Japan has raised interest rates. The European Central Bank has raised interest rates. So we're definitely in a different market and a different environment than maybe we were in the last 3 or 4 years.
Yeah, it's always changing for sure. And I think I think one of the things we're starting to see is that the story that we thought was maybe the case last year, that interest rates were going down to zero under Trump and this new Fed chairman, probably not the case. And with everything going on in the world, even going back the last few years, but the last couple of years, there's forces that are making things like inflation stickier and hang around. So the idea that interest rates are going down to COVID levels is probably not a reality here. And I think when you look at more recently all the disruption in the Middle East, supply chain or oil disruptions there, we've now had Bank of Japan, ECB raising rates because there's inflationary pressures out there. You think even tariffs were very disruptive and certainly put more pressure on the inflation numbers and global economy. And then you talk about even the whole idea of all this nationalization, all this reshoring. It's no longer things are being produced all over the world with open borders. There's a lot of stuff coming back home to home countries being produced there at higher price points. So that was one of the things that came up. This inflation is probably pretty sticky. It's like once it's there, it's getting into the carpet, it's getting out of the seat cushions. It's tough to get rid of, and I think that's probably true when you see where this market has been headed overall.
Well, to that point, the new Fed speaker, Kevin Warsh, he said that over the last 5 years, inflation, the goal of the Fed chair has been to get inflation down to the 2% target, and it's been running above that for the last 5 years. So to your point, Will, it's not easy to get rid of.
Yeah, and I mean the Fed, it's kind of a moving target, and I mean if you look at stuff post COVID, even though inflation is in that 3%, I think a lot of things practically are 50 to 100% higher than they were five years ago or so because of everything that's gone on, and so that's kind of the reality of the world that we're in. Is inflation? Yeah, it went up high single digits, way up close to 10% a few years ago. It's come way down, but it hasn't got back to those levels, and it seems to kind of be sticky. And now with all this disruption, I think that's one of the bigger kind of risks and concerns that we see. And we have talked about that quite a bit, that we're probably going to see this transition from the whole technology driven market, one that's a market where these long duration type of assets do incredibly well, and tech's growing and all these growth names go to one where you probably want to transition to more real assets, hard assets. We've talked commodities is an example of that. Value types of stocks, dividend types of stocks. Not that transition is there or has happened yet, but when you look, even the last few months is something that was talked about the other night. The Nasdaq in March was something like 30 trillion of value, and now as of today, it's 40 trillion. So for there to be a little bit of a rotation out of the Nasdaq, out of technology stocks into some of these other pockets and areas of the market, I don't think that is too far fetched. So I mean, we might have been a little bit early on some of it for sure. I wish I had a crystal ball and perfect timing, but some of the technology pieces we've lightened up over the last few months, taken some of those names off the table and have reallocated to other areas. But I think from a bigger picture, directionally positioning wise, yeah, it's not happening today. It's not happening tomorrow, but that's where we see things shifting and moving more towards.
So with those hard or tangible assets that you talked about, Will, is it only commodities, or does some of that constitute some tech exposure, or maybe what does that mean?
Yeah, I mean, look, I think that what we're talking about when we talk about hard assets, the physical assets, it's not necessarily just commodities. I mean, that's certainly part of it, right? When we've talked lots about things like precious metals and base metals and energy and things like uranium. Like uranium's there, which we own, powering the whole AI infrastructure story. But I think things that are more anything you think of it that is more physical, like infrastructure is a good example. Like we've got a couple global and U.S. infrastructure investments. Caterpillar is a good example of that. Yeah, it's definitely been a growth name, but it's physical equipment. It's in that realm. It's building. It's hard assets. It's dealing in the commodities, the mining space, the infrastructure space, AI. Um, you're just seeing this trend, even when it comes to technology. And it's not to say that semiconductors can be incredibly cyclical, but it is the physical part of the technology trade. The semiconductor index is the picks and shovel, and you look at all the software companies that are out there, they've pretty much been decimated, so to speak, because it's not hard, it's not tangible, it's not a strategic resource software at this point. It's much more. It's not. It's much more speculative. So it's these strategic resources. Those areas are more where you want to be. Don't get me wrong. The semiconductors is certainly the growth area of the market. So it's maybe not the best idea when we talk about the value assets and the dividend assets in that area. They're certainly not that. But that's thematically what we're seeing is that you want to have that focus more so on hard assets, real businesses, real cash flows. And in this type of environment, if it's inflationary pressures or higher interest rates, it's going to do a lot better than the speculative areas. Say, like we talked about, the SpaceX is probably, although it kept going, and I think pulled back, it's probably a little richly valued.
Yeah, I think that's an understatement. But obviously, well, no two markets are alike. But are you seeing some similar trends and themes to maybe kind of what we saw in like 2022, where growth fell completely out of favor and things like the TSX, value, dividend names were actually holding up relatively well?
Yeah, that's probably the best example in recent memory, and we've talked about this historically. That like you can go back to see what the pattern was like in 2022, where the Nasdaq lost 40-50% of its value. But when you were in these more value areas, hard asset areas, kind of the real economy, so to speak, it fared much better. But it's also like it's not a really not a negative comment on the market. It's just a question of positioning, because it's not to say that the whole market is like, if things rotate out of technology into other areas, it's not to say the whole market's necessarily going to collapse. It's just that if we're positioned in some of these other areas that stand to benefit, which we have been by and large the last couple of years, you're in a much better spot than being too heavy in technology or even too heavy in the indices. Like that's the thing, the Nasdaq indices or S&P 500 is basically 50% technology. And look, we've got our fair share of technology as well, but we've blended that out with a lot of more value and real assets and hard assets and commodities and other areas to balance out the portfolio and strategy. So it's really just a matter of positioning here, shifting and adjusting based on changing conditions. But I do think that's one of the things that we're seeing in the world is this trend towards real assets, hard assets, much more over financial assets, and speculative assets is where you're going to want to be in this market environment.
And is there some added risk just given that technology in general over the last 3 or 4 years has been kind of riding the wave of lower interest rates, lower inflation, and now that we're starting to see interest rates pick up, inflation pick up, because those are the most sensitive areas of the market, that it could just soften the market altogether?
Well, for sure, right? I mean, the tech, as I mentioned, is a huge part of S&P 500, and it's pretty much the whole Nasdaq at this point. It's just dominating the indices. Where Canada, I mean, Canada really has few and far between like AI types of names. The tech companies that even made up the index, like the TSX, like Constellation, as an example, has been beat up. So I mean, the TSX is really not at all tech heavy. So that's a very simple example for us, and a Canadian friendly example is you would much rather have correlation with the TSX, in my opinion, than the NASDAQ here because exactly that real assets, much more of a value index, more commodities, more industrials, these types of areas of the economy are what's going to do well here. The technology area, what worries me a little bit is this an environment like 2022, or we've said before the 2000s, or we could go way back. I think from a general perspective, you probably want a portfolio that more is like the 1970s than you do, say, the 80s and 90s, so to speak, because of the environment. I mean, that's a little bit extreme, and it's a pretty old historical perspective, but markets go in cycles, they move in longer term patterns. And I think what we're starting to see is a change in the cycle where that low interest rate, that high growth, long duration trade of the market is probably getting a little bit long in the tooth here.
So, Will, there's been so much within the first half of the year. It's all been about Iran, US, the war in the Middle East, interest rates and inflation have dominated. Is our kind of thinking and thesis is to kind of block out that noise, and we're not so much worried about the day-to-day headlines, but more worried about the longer-term positioning and where the longer-term trends are moving.
Yeah, look, it's tough to block that out and ignore it entirely because it's driving markets. But I think if the positioning is right, if the strategy is right, you're in a very good position and navigate through and really have an all-terrain type of portfolio, all-terrain type of vehicle that's going to navigate through any sort of market environment. But all that feeds in, like we've talked about this too, this changing world order. There is heightened political, geopolitical instability, to say the least. But all those things, war in Iran, tariffs, all this, nationalization, reshoring, all that feeds into the inflationary pressures. There's a lot of factors at play. And so I think just the way the world has changed, it's leading to that sort of environment. And there's just more countries, companies, everybody, they're gathering up these strategic resources. Everybody's not freely trading and shipping their goods all over the world easily, right? There's so much disruption that all that has a tendency to cause inflation. So it's not to say that inflation is it's the prince and all of that are going to come out sky high or anything right away. But I mean, we saw that in 2022 that it took some time to bleed through, right? And so this starts to feel like when you got the IPOs coming out, you've got SpaceX and all that. It reminds me of 2021 as you got later in that phase. I think as when we got to November of 2021, the
Yeah.
Nasdaq took its first dive and then took a few more rallies and dives again. But it's just the environment, and it's like it doesn't mean that there's not opportunities out there. There doesn't mean that there's not positioning. I would just be careful about that because the hype, the optimism is getting so extreme with some of these areas. And like we still have exposure. I think in some respects you have to have exposure, and you'd be entirely missing out if you didn't. But it's something that we're paying attention to what's happening in this cycle, looking at the patterns, looking at history, looking at where the world's going. And I think that's the environment we're moving towards, where you're going to want to have real assets, hard assets over financial assets here.
Yeah, and I mean, we're not quite halfway through the year, but we almost are. And I think portfolio's done exceptionally well. Markets in general have been a little bit more robust, but I think for the back half of this year, we're just that inflation story is going to continue to develop, and positioning is going to be what matters most here.
Oh yeah, and so we'll keep managing to that, keep positioning, repositioning, tactically, strategically portfolios. But just to give you an idea of where things are headed, and I think there's still good opportunity, good potential. But that's what we want to do. We want to manage that risk, govern the portfolio accordingly, make sure we're there as well to take advantage of opportunities and capitalize on what's going on in the markets. But as always, we want you to be wealthy. That's what this is all about. We want to see your portfolio growing, moving in the right direction. We want you to feel wealthy, enjoying life, enjoying retirement, enjoying your money. We want you to realize your wealth. That's what we're all about. That's what Aretec Wealth is all about. We'll be back with everybody next week.